it seems that we've been in a race to fostering this expectation of a rate cut, which wasn't so clear, at least in terms of market pricing, just several weeks ago. And of course, the clear catalyst has been here, the lower growth expectation coming out of April 2nd's announcement related to the US tariffs. And on top, an exchange rate reaction that is not really in line with what many observers had expected for more tariffs. So more tariffs were previously associated with a lower value of the euro, hence inflationary. The opposite has happened. And of course, that has contributed to an expectation for the cut. So now your question, what can they do? I think one of the debates will be indeed whether the statement language should be changed or not. I think personally that's unlikely that we see a big change, simply because there is no new projections, a lot of uncertainty, and right now in that situation, probably you're well advised not touching, in particular, references to policy being still restrictive. That could have been before or taking out April 2nd and a completely different macro backdrop. That could have been previously a compromise to get the April cut, but then maybe signaling a pause is soon to come. So essentially, the positioning should remain the same as we have seen out of the March meeting, namely a downward bias. Remember, she was saying clearly rates can be kept on hold or lowered. And so that's a downward bias, and that downward bias should be kept.
Jens, you mentioned the stronger euro and the sort of unexpected move that we've seen in FX markets since President Trump announced his tariffs, which, historically speaking, you would have expected to lead to a stronger dollar. That hasn't been the case. How do you explain the stronger euro, and does it make sense from an economic perspective when you unpack the impact of these tariffs?
I guess if we sort of think through how this came about, so what is the expectation here, then clearly it's a goods market-centered expectation, in the sense that you say, oh yeah, we have a new tax on imports, and then to the extent that relative goods prices explain exchange rates, you would have expected that the exchange rate to some extent is going to buffer that shock. Now, obviously, the market movement and the broadness of the tariffs has brought to the fore some other questions in terms of the asset allocation. In general, we hear this a lot from investors that think that maybe there is a doubt as to whether they want to keep a very high percentage or that high percentage share allocation to US assets in a backdrop where the growth outlook for the US economy might be significantly weakened by the tariffs. And so there is certainly an element here that is going beyond the simple pricing explanation or the goods price explanation of the exchange rate, that goes more to financial flows. And I think that's probably what's happened here. The broad side that we saw in terms of tariffs against everybody, and then of unknown magnitude, because it's not clear whether, for instance, where the trade conflict will end vis-a-vis China. All of that probably has put into question the growth outlook for the US. I think that has probably, in our investor conversations at least, been the dominant theme, whether we will see a recession in the US or not. And that very likely has dominated here the move in the exchange rate.